Good afternoon, all. Welcome to our today's webinar on changing landscape of tax in merger acquisitions and restructuring. The Bengal Chamber of Commerce and Industry, along with Dhruva Advisors, are jointly organizing today's webinar. I now request Mr. Vivek Jalan, who is the chairperson of the Fiscal Affairs and Taxation Committee of Bengal Chamber, to start the session and present Chamber's overview.
Thank you, Sharwani. Am I audible?
Yes.
So, good afternoon to all the members of the Bengal Chamber of Commerce, all the participants and members from Dhruva Advisory LLP. Thank you all for joining this webinar on M&A landscape and restructuring from the point of view of income tax, organized by the Fiscal Affairs and Taxation Committee of the Bengal Chamber of Commerce in association with Dhruva Advisors. Friends, the Bengal Chamber of Commerce and Industry has been instrumental in implementing the income tax law in 1961 itself. And over the years, it has been our endeavor to add values to the stakeholders of this law. Very recently, we have in the pre-budget recommendations represented before the Union Minister of Finance, Government of India, on the various issues in income tax faced by the MSME sectors, like the delay in payments from the customers by the MSMEs, linking of PAN and TAN, doing away with Form 26AS. Many of these representations have seen getting into the Finance Act 2023, and some of these recommendations of the Bengal Chamber of Commerce are at an advanced level of discussions in the Ministry of Finance too. As far as M&A is concerned, very recently, 2-3 days back, the RBI has come out with the variation data on balance of payments. And it is seen that vis-a-vis last year in 22-23, the FDI inflow has seen an uptick of $28 billion in India, which means that M&A and restructurings would see an upswing even in 23-24. As against the global headwinds, India would be a bright spot. And in this webinar, organized with Dhruva Advisors, I'm sure there are a panel of speakers here who are experts and in this space, and they would be taking you through the various issues and the recent developments in this space, and they would also be answering all your questions in this regard in this webinar. So thank you again for joining this webinar, and we expect that this would be an enriching experience for you. Thank you very much. Over to Sharwani.
Yeah, thank you, Mr. Jalan. I now request Mr. Aditya Hans, partner from Dhruva Advisors LLP, to introduce the program Changing Structure of Tax, the technique in merger and acquisitions, and take forward the technical sessions, along with Mr. Basant Gadhian, principal from Dhruva Advisors. Over to you, Mr. Hans, please.
Thank you, Sharwani. Thank you, Vivek. First, my sincere thanks to the esteemed guests who have joined. I've kept this in the afternoon, not one of the best times to have such a session, but didn't want to keep it very late, didn't want to keep it till early, but I think so we've all completed a part of a day's work. So good time to listen to an interesting session. So good afternoon to all of you. It's my pleasure to extend a heartfelt welcome to this distinguished webinar on the evolving landscape of M&A tax in India. Now, allow me with my esteemed colleague Basant Gadhian, we both will delve into the recent developments in the tax realm that are poised to have a significant impact on M&A transactions. transpiring within the tax landscape. I will commence our discourse by emphasizing the paramount importance of tax considerations in M&A transactions. It will be followed by an overview of shifting landscape of M&A tax in India. Subsequently, we'll delve into the recent changes of the Indian tax laws, exploring the consequential effects on the M&A transaction. So we have all heard about angel tax. We've all about the recent rulings, as simple as transactions as right issue, buyback, a subscription of shares, all of them, there's enough litigation and enough debate and enough contentious issues being created by simple mere sections which were introduced sometime just way back, sometime around 2010, then amended in 2012, and that section which was introduced in 2010 has now become a very draconian section. Now, tax is a very crucial factor when you consider an M&A deal. It could be a deal breaker, it could be a deal maker at times also. I will not say that an M&A or an acquisition happens only for tax, but it happens for commercial consideration, but could be a deal maker or a deal breaker. It can greatly impact the value of the structure of the transaction. For example, when a company plans to acquire another company, you need to think about the potential tax liabilities and the benefits that will come along with the acquisition. Tax considerations stand as one of the most crucial factors in an M&A transaction. For instance, when a company contemplates acquiring another entity, it must diligently scrutinize the tax implications inherent in such an acquisition when a company is issuing shares or repurchases its own shares also. And we will discuss that, how this becomes so crucial. In a simple reorganization within a group also, this could become a very much a litigation issue. Here, the valuation aspects, whether it's a buyback, whether it's a right issue, whether it's a subscription of shares, all of that become important. The company must ascertain the potential tax liabilities stemming from a transaction in a merger, in a demerger, in a slump sale. Because of these tax implications, one may actually look at alternative routes of doing a transaction also. But the objective being the same. So tax is not driving the transaction. The end objective is the same. It's just the modus operandi or the route to reach that same end objective could change. Now, depending on the specific circumstances surrounding the deal, the tax implication of an M&A transaction may vary. Moving forward, let us now discuss the evolving landscape of M&A in India. Over recent years, M&A activities within India have undergone rapid transformation, with the Indian economy experiencing, as Vivek highlighted, robust growth. The M&A tax landscape has become increasingly competitive. So when I say FDI, when Vivek says FDI is not only just capital coming in and a new setup being there, it could be acquisitions also. Rather, a substantial part is there towards acquisitions. Against this backdrop, the Indian government has implemented several significant changes in the country's tax laws and tried to iron out deficiencies and provided clarification from time to time, but has inadvertently also ended up creating more complications in the way also. Litigation, fraught with debate, filled with all of these issues. Rather, an angel tax is like opening a Pandora's box. Some say it's a relief, some say it is opening a can of worms. It will create more issues. Time will say. Well, the rules, the valuation rules are in its draft stage. All participants, all stakeholders have given their comments. Let's see what is the final shape and form. We'll discuss that also in the session. Simultaneously, courts and tribunals have also held past judgments on various critical matters impacting the M&A landscape, based on valuations, on the power of assessing officers in court-approved schemes, meaning of undertaking for the purpose of business, applicability of deemed gift tax provisions on corporate actions like right issue, buyback, or as simple as an issuance of shares to existing shareholders or new investors altogether. In this backdrop, interestingly, government has now come up with angel tax related draft rules with special focus on non-related investors, which is about to bring a sea change in a manner shares are valued. Rather, you will have to do a lot of planning around it also when fresh capital is being invited from residents as well as non-residents. So it was an issue from 2012 with when infusion of funds were done by residents, but now they've expanded it from 1st April 2023 for non-residents as well. Interestingly, the law is effective from 1st April 2023, but the valuation rules have not yet been finalized. The related complexities on taxability of such issuance by Indian companies and its connected impact when shares are issued to resident investors will also be interesting in times to come. These modifications have a substantial impact on the M&A transactions which happen within India. Naturally, the changes of Indian tax laws present both challenges and opportunities within the realm of M&A in India. Challenges arising in the form of complying with the rules and regulations, as well as crafting the way you would want to do that transaction to ensure that there is an optimization in tax. But yes, tax not being the primary objective, tax just being making you think for an alternative route to reach the same end objective, which is a commercial rationale to undertake a particular transaction. However, India's growing appeal as an M&A destination and government's effort to create a competitive tax environment offer a lot of opportunities. Before we now delve into the technical aspects, I would also want Basant to just set the tone for a technical session. Basant.
Yes, Aditya, thank you so much. And thank you, BCCI. So Aditya, if as you spoke about very simple as transactions like a share issuance, buybacks and all, and over the past 12 months or so, we have seen more than half a dozen decisions which has come with respect to taxability in the hands of the company, as well as taxability in the hands of the shareholders or in the hands of the investors, so to say. Whenever there is a mere issuance of share or a private placement, or there are some rights issues being done where, only some investors put in the money, at times when there are repatriation of funds by the company through buybacks. So all these corporate actions which are being taken nowadays by various companies, we have seen a lot of issues which have been addressed by the ITATs in the last 12 months or so. So it will be quite interesting to go through these decisions, and if you can share some of the recent developments in this space so that the audience here is enlightened in terms of what really is happening in these areas which are not, so to say, NCLT driven schemes, but more of a non-NCLT driven restructurings, because obviously when there is any group restructuring prior to getting into NCLT, there are internal actions which also needs to be taken to have us to achieve us objective which is more smoothly undertaking. So request if you can go to some of these decisions where we can get some thoughts on what's going around in M&A on issuance, buybacks, rights issues also.
Thank you, Basant. If you could just help me flip the slide. Yeah. Now, something as simple as an issuance of shares has thrown up. I was looking at the number of rulings. Probably, you could have a folder filled with rulings on the same issue, where the assessing officer, even after the SSC has selected a particular method in the valuation of shares for 5627B, and the assessing officer still being adventurous, even though it's very much clear that it's a prerogative of the SSC to decide what valuation method it decides. There are umpteen amount of litigation which is there. Now, I will refer to this ruling of SB Industrial Engineering, which is it's a 2023 ruling of the Chennai Tribunal, and which has relied on Siniston Entertainment, which is another ruling. And the key principle which is emanating from these decisions are that even if there's a difference between the revenue projections and the actual revenue earned, it cannot be treated as a ground for rejecting the valuation methodology. And if the assessing officer does it, it is erroneous adjustment. This is not correct. See, but also let me highlight one particular point, that it doesn't give immunity that the assessing officer cannot. So the assessing officer cannot change the method of valuation, but it can delve and ask you and go into the more details of your workings and ask for all of that. See, it's a settled law that it's a right of the company to issue shares and to choose the valuation methodology under the provision of the Act. But still, the immunity is not there that you that the assessing officer doesn't explore it. So many people take this ruling of SB Industrial, Siniston, and scores of rulings. Rather, if you find a negative ruling, it may be one one odd or something like 1 out of a 10, which will be and which will not be very well drafted also, or very much not clear also. But one should be still clear that when you're doing a valuation, because the assessing officer still has a right to challenge your valuation, follow the same method of valuation, correct the assumptions, rectify the assumptions which are very based on whims and surmise of the SSC where there's not adequate backup. Hence, my request to all of you is, otherwise, the way the litigation continues, it will keep on continuing. You may keep on going to tribunal. And what I've seen in most of the tribunal rulings is that the bench has said that we remand it back to the AO. So I think so. What the SSC should do is have a robust valuation report, have a clear-cut backup of the projections with underlying facts, assumptions, all of it, using whatever growth rates it's using, the metrics. There should be all rational backup. Say there's contracts expected, it's bidding for the contracts, the sector where it is going, where it is expecting to get its revenues, and realistic assumptions of revenue and cost. And there should be a sanity check also. Just don't blindly rely on your valuer, because he may have a set of assumptions or caveats or disclaimers provided, which may jeopardize your situation. See, you will eventually win, because if you've adopted DCF, it will be DCF. He cannot make it an NAV or a book NAV or any other method. That right is not there with you, but he can improve upon your DCF, or even if he doesn't improve, it will become a cyclical process because you have a bad report. He the number of rulings which I've seen on this issue is endless. I don't know why, because probably the quality of the valuation reports are not good, or the assessing officer is still wanting to keep beating around the bush that no, I will want to tinker with your valuation. You cannot tinker with the valuation method selected. You can tinker, and rather the assessing officer, if it is smart enough, he should objectively come up with points but that's very a rare phenomenon. In 1 or 2 rulings only I could see they had come up with some objective points. And I have I've dealt with such cases where if you give a rather interestingly, I've seen, and in our personal experience also, I've seen that even if you give a better valuation report or a very optimum quality valuation report at a later point of time, the valuation report may have been issued today, but if it is of a date when the transaction took place, but even if it is submitted at the higher level of appeal, it is admitted. So you can keep going in cycles till the time you get back with a robust valuation report. So why not do that at the outset? Now, something like Basan, can we move to the next slide? Now, something like a simple conversion. Rather, I'll just explain what was there in Milk Mantra. It's a Kolkata tribunal ruling, and in a very recent ruling of 2022. So, in this company issued compulsory convertible debentures to its investors, and subsequently the CTAs were well, it's been a debate that are these 2 transactions? Are these one? Is this one transaction? When do you look at the valuation date when the CCD is issued? Because eventually it will be converted to equity. The debate keeps on happening and happening and happening. But in Milk Mantra, I buy into the logic which was provided. The ITT deliberated on the phrase consideration, in which the taxpayer had received at the time of conversion of CCD to equity, and which included debt obligation is relinquished, the interest cost of the debt, risk of getting dragged into an IBC process if the company defaults is mitigated, the financial ratios of the SSCs have improved. So all of these points were discussed, and the conversion point was taken as it was held that the consideration has been received by the company at the time of issuance of shares pursuant to the conversion, and not at the time of issuance of the CCDs. And it acknowledged that 56(2)(7)(b) would apply. So if you see the 3 questions which generally come, will section 56(2)(7)(b) apply at the time of conversion of CCD into equity shares or at the time of issuance. It is not at the time of issuance, it is at the time of conversion. Consideration received, it's not only the money. So if it is money, then it would have been when the CCDs were issued. No, here when the equity is issued, that consideration has a very wide definition. So it is not only the monies. But very interesting fact that there was around the same time of 2022, a Mumbai tribunal which gives a little contrary ruling. This ruling actually involved, which is, if I've cited it out here, Rankin Infrastructure, DCIT versus Rankin Infrastructure 2022. It involved the conversion of OFCD into non-cumulative preference shares, which is optionally fully convertible debentures into non-cumulative preference shares. And the tribunal deliberated on the phase receives. So, which entails the receipt of funds at the time of issuance of the shares in the same assessment here. So here the ITT was of the view that 56 to 7B cannot be invoked merely because the conversion took place. But I'll tell you there are more rulings which support the milk mantra. One could take cover under Rankin, but I think so. If you take cover under Rankin, there is going to be civil litigation. Rather, I think so. One could plan around milk mantra ruling the principal setup. It will be. But I can understand there are commercial realities when you may want to apply the principles of a ranking. But again, if you see, there is one Kolkata tribunal and a Mumbai tribunal, and there are many more rulings of different tribunals which are in line with milk mantra. So a contentious issue. So if you are looking at convertible instruments and then their conversion, please be mindful that you need to plan it out very well. So as I said, a simple issuance of a CCD or a simple issuance of an equity could also lead to a significant amount of litigation. Now, if you are talking about issuance of a CCD, issuance of an equity, what about cancellation of shares? And when I say cancellation, I'm not going to capital reduction. I'm simply going to restrict my discussion to buyback of shares. Basan, can we move to the next slide? Now, I'll discuss a fact, very simple, because buyback generally looks like a no-brainer, and I think so. There's a consensus of the position which we'll take. So, company bought back its shares at a face value, which is lower than the book value per share. Now, AO taxed the difference between the book value and the face value, which is under 56(2)(7)(a), was under, so erstwhile. Now it is 56(2)(10), subsumed into 56(2)(10). The question which arises whether the difference between the book value and the face value will be taxed in the 56(2)(10) today, or receipt of own shares by the company on buyback qualifies as a property under the Income Tax Act. Now, since the value was lower than the book value, the AO taxed the difference. But in VITP, if you see, which I have referred in the slide, the Hyderabad Tribunal relied upon the decision of Vora Financials, in which Mumbai Tribunal specifically delved into the issue that whether the shares received by the company in case of buyback will be treated as property, and this is very critical. Now, in case of buyback, shares which are received by the company are required to be extinguished immediately. As a result of such share fails to qualify the test of a property. Property is something which you enjoy, you can transfer, you can do a lot of things, but here you are constrained within the law to take it and extinguish it. And so it's not and mandatorily under the regulations. So something which you cannot enjoy, does it fall in the definition of property? There are rulings which support that no, it is not following the definition of property. And accordingly, the rigors of 56(2)(10) will not be applicable. So there are no buyback guidelines in the Companies Act. There are no buyback pricing guidelines under the Income Tax Act. So that's the way the position stands today until government comes up with a clarification. Now, I will touch upon one more simple issue. So I've been touching upon the simple issue because these simple issues even have been throwing up so much of litigation, something like a right issue of shares, subscribing to right issues. Basan, can you move to the next slide, please? Now, in this, Basant, can you move to the, yeah, thank you. Now, the company issued rights shares to all its existing shareholders, and this is a very recent ruling of 2023 about ITO versus Chhattisgarh Metallics, Raipur Tribunal. The value per shares were over and above the FMV of the shares, and the proportionate shareholding of the company remained the same post allotment. Now, so someone subscribed, someone didn't subscribe. Now, whether the provisions, these questions come up. So whether the provision of 56(2)(7)(b) will apply on the issuing company, and what is the difference between disproportionate allocation and disproportionate allotment? Rather, if you see many of the rulings, disproportionate allocation and disproportionate allotment has been used as the same word, synonymously to each other. But in one of the rulings, it was differentiated, and in some cases, disproportionate allocation has been seen as same as disproportionate allotment. Now, the Raipur Tribunal held that the excess money received would not be subject to tax as the shareholding percentage of the shares pre and post allocation of the shares were the same. Now, ITT, it relied on which ruling? It relied on the Mumbai ITT ruling of Sudhir Menon 2014, and then there was another Menon ruling, I think so, of recent times, which was there. And then there's a Rajiv Ratanlal Tulsian, yes, that ruling is also there. Now, interestingly, in another ruling in Jigar Jaswal Shah, which is an Ahmedabad tribunal, held that the erstwhile 56(2)(7)(c) would come into operation only where there's a disproportionate allocation of shares and not a disproportionate allotment of shares. So, what is the distinction between a disproportionate allocation and a disproportionate allotment? So, if I'm giving this right to all my shareholders, I have 10 shareholders, I'm giving this right to all my shareholders. And if some subscribe, so that will be seen as a disproportionate allocation. But out of those 20 shareholders, 5 of them subscribe to this right issue. That is allotment. So I have allocated it to all, but allotted to who opted for it. So here it will be seen favorably that here 56(2)(7)(c) or any of the 56 sections would not apply because there was not a disproportionate allotment. Sorry. Now in Rajiv Ratanlal Tulsian, it mentioned the word disproportionate allotment and not allocation, but I think so in spirit it meant allocation only. That is, shares are allotted pro rata to the shares based on the existing shareholdings. There is no scope for property being received by them. So I think so. If in a right issue with appropriate documentation, one can demonstrate that it was offered to all, and so there was. If one can prove that there was not a disproportionate allocation. The moment you can prove there is not a disproportionate allocation, so I think so you will be safe. And so I cannot assure you that there will be no litigation, but at least you follow the principles which are emanating from most of these rulings. A quick recap: we discussed simple issuance, we discussed convertible instruments, we discussed buyback, we discussed right issue, in which the disproportionate allocation was a very critical thought. Now, as a last simple thing which I will discuss is, Basant, can you move to the next slide? At times you find that. So, what was the objective of 56? It was the effort by the government to ensure that it was more of a SAR actually. If you see, special anti-avoidance rule, where it didn't want that non-disclosed income or unwarranted or something which is not correct income or that is coming into the companies. So it wanted to tax that. Rather, 68 was applied from the other end at source and all of that. That whether what is the source, the origin, and all of that of the money, and that is explored. Rather, we've seen in certain cases 56. to 7B is explored, and on the contrary, on the other side, 68 is also being explored by the assessing officer, rightfully, if the source and everything is not properly disclosed and all of that, that should be the thing. But when it is a wholly owned subsidiary, I think so it was stretching it too much. It's coming from a wholly owned subsidiary, when the source and everything is all known. I think so that is where you're stretching the machinery provisions to a level where, and applying it to a place where it was not intended. Well, the government introduced 56 to 7B with the intention to prevent unlawful gains by the issuing company in the garb of capital receipts. Now, underlying intention between the introduction, behind the introduction of section 56 to 7B, as which was squarely covered in the decision of Ozone India. The intent to introduce 56 to 7B was to curb tax evasion by closely held companies through practice of issuing share prices substantially higher than fair market value. Based on the objective behind the said section and then relying on other decisions of the ITAT, which has held that 56 to 7B could not be applied in case of transaction between holding company and wholly owned subsidiary, as the ultimate beneficiary is eventually the holding company. So if there were 3 shareholders and I was trying to do something of that sort, I could have understood. But when it is with the wholly owned subsidiary, I think so, an assessing officer, I agree the fair market value price and all of that may not be matching. But then who am I going to pass on the benefit? Rather, if you remember, there was a Shell India ruling and there was a Vodafone ruling also, where it was discussed that what are we trying to achieve, because it's a wholly owned shareholding, although it was cross-bought, it was non-resident. But what are we trying to achieve? Whom am I going to pass on the benefit? If Vodafone or a Shell is going to bring the rulings, they were all held in favor of the taxpayer. With this, 5 very basic issues, but with a lot of litigation around the subject, I thought I'll touch upon it. So anytime you're looking at a simple issuance or a right issue or a simple buyback or a convertible instrument, please apply these principles. They may look very mundane, but they could create a lot of litigation. I can assure you that a lot of litigation is happening around these simple basic issues at the moment. The next part which I would like to cover is the angel tax. I will not discuss this very much in detail, because if I want to discuss this, it could take a session in itself. Basil, can we move to the next slide? I will touch upon this topic. Yeah. Yes. So very recently in the Finance Act 2023, and as you can see from this memorandum to the Finance Act 2023, 56, as if 56 to 7B had not created havoc for the residents. The government has now extended this to non-residents as well. And this is what the memorandum says. They have removed the phrase being a resident. So by virtue of this, they have brought non-residents also within the ambit. And I can tell you the amount of representations and amount of hue and cry which is being created since and the government then probably came up with the notifications. Moving to the next slide, Basant, if you will move to the next slide. Yes. So post the amendment, they issued a press release on 19th May, where they gave a couple of reliefs. Then they issued 2 notifications, notifying class of non-resident investors whose investment should be excluded from angel tax, and extending relief to startups registered with DPIIT. Someone gave me a number, right? Probably 80,000 startups are now exempt. I don't know where did that number come from, but I saw a reference of that somewhere. And if that is true, well, welcome move. So probably the government listened and brought in these notifications It also brought in a notification where it amended the 11-year rules, because with non-residents coming into the picture, the existing valuation rules which were there, it does need modification. And it's not finalized, although technically speaking effective, but it's also mentioned that the date an official gazette is notified, it will be applicable from that day. But the law is applicable from 1st April 2023. These draft rule, they invited comments from the industry and all players, all stakeholders. The comments were received till 5th June, but the final law is not in place. Final rules are not in place. I'll give you a snapshot of the rules because they are not final, so I don't want to delve too much deep into it. But yes, it will be something. So I'll give you a clarification of the law, the two notifications, and the draft rules. So Basant, can you just move to the next slide? So both resident and non-resident investors are covered. For the non-residents, they brought in 5 additional valuation methods. And this is with the objective aligning with FEMA, because FEMA says international best practices. And if it's an international best practices, so they added what they felt were 5 international best practices, giving more wings of valuation to the non-residents, but interestingly not to the residents. So now exemption from angel tax is extended to notified entities from specified nations. There are 21 nations which have been specified. And believe me, Mauritius and Mauritius who's compliant with the FATF and many other regulations, all of those anti-abuse regulations and everything. And it is crying you that why have you left me out? Rather, we were seeing that 4 odd countries or 5 odd countries, if you take those 4 to 5 countries, probably 50 to 60% of the FDI comes from these 5 countries, and they've been excluded. So that's, I don't know what mind was applied there, or probably they see these 5 locations as conduit entities and not where the actual funds flow from. Interestingly, a price matching method has been also introduced, and this is for both for residents and non-residents. So it's something like a transfer pricing methodology that a lot of, so if you look at the preceding point, that exemption from angel tax extended to notified entities. So when notified entities, when funds are coming from notified entities from specified nations, a lot of data points of third party is getting created. So you can use those data points also in the range of a particular period. So that is something interestingly which has been provided. Safe harbor that this can vary up to 10%, but this 10% variation, that your price and the price at which you transact and the data point, or sorry, the valuation methodology, it could vary up to 10%. But interestingly, this safe harbor has not been provided to the pricing matching method. It's something like if there's a data point which is singular pricing data, that has to be accepted. But when you're looking at from a non-resident perspective, the 2 valuation methods and the 5 additional valuation methods, all of this put together, you can have a variation of up to 10%. Now, some practical issues which are generally there, they have been also provided. 90 days in which you can provide a merchant van. So generally, it used to be the date of the transaction. So they've understood that you can take a valuation report within the 90 days window. And as I said, there was I don't know, I read it somewhere, so I just thought it's not a snapshot of the regulation, actually, the last point. There are probably 80,000 DPIAT registered startups get exempted. So this is a snapshot of the regulation. There's another slide to it, just clarifying that the notified entities from the notified jurisdictions. So it is generally for the conditional exemption. If you see the one which are red shaded, whereas the blue shaded ones are a blanket exemption. So this the blue ones coming from anywhere will be exempt, whereas the red ones, it has got to come from the notified countries. If you ask me, there's a lot to discuss in each of these, but I'm not touching upon it because then that's a session in itself. And these are not finalized. There's still deliberation going on, still discussions going on. Probably we'll have another session, discussing this in detail when everything is finalized. Moving to the next slide, Basan. See, I did a simple search and I said, what are the recommendations which have gone? So probably some chambers of commerce and chambers of tax, all of them, and some bodies have written to them. I just put some of the pieces together. Something like extending of new valuation methods to residents. So if you see, 5 methods have been added. The pricing is available to both resident and non-residents, but those 5 new methods which have been added as per international best practices, they should also be extended to the residents also. That will be prejudicial if you don't do that. Second is the application of methods in combination, and I think so. See, I've seen so many valuation reports in third-party cases, third-party transactions, and I've seen the way very good quality, top quality professional valuers, they generally say that it is very difficult to value a company in a particular manner. It should be a combination. So now that when you're giving a non-resident 5 or 7, or rather from 2 to 7 methods, and a resident you're giving 2 methods, you should also give a combination to mix them, because good quality valuation report don't say that a valuation can be, because you said it's not an exact science. You cannot have a single data that this is the number. It could be a range also. So if you can allow a combination of methods, that would be something a very fair ask from the industry. Now, if you see, all this has happened for equity shares only. And the Rule 11UA, which stands today with respect to preference shares, is very open-ended. Now that open-endedness could have been closed under this also, but they've kept it still outside. So all these amendments which have been done in the valuation and all of that, that the convertible debentures, bonds, because if you see, you're bringing non-resident investors, and it's a very common phenomenon that non-resident investors invest largely in convertible instruments, and then they convert after a phase of time. And you're not giving clarity on the convertible instruments. So there is going to be a, you're just keeping something ambiguous. I think so. You should have clarity on that also. I can understand when it was under domestic, it kept it open-ended. And we've rarely seen much litigation around that. Rather than the conversion, at the point of conversion, we have seen litigation, but at the time of issuance of preference shares, if you had a valuation report, that was sufficient. I've not seen much litigation around that issuance of convertible share, but at the conversion, yes, there was a lot of litigation around that. Now, if I look at the the fourth point, actually, if you look at the FEMA regulation with respect to convertible equity instruments, the FEMA regulations say that the conversion has to be provided at the outset when the convertible instrument is being issued. And our 11UA works in a manner that it says, and we were discussing the ruling sometime back, the Milk Mantra ruling, that at the time of conversion, you will see the issuance price. Now, isn't that contradictory? Now, if you are looking under income tax at the time of issuance of the equity share, that is a convertible instrument getting converted into an equity, you're taking a valuation at that point of time. And for FEMA, you're taking a valuation at the time of subscription of the convertible instrument. You're getting 2 price points. You are actually going to get into a conflict zone to comply with FEMA or to comply with income tax. I think so. This definitely needs clarity. And I can say one thing, that the cost of compliance is increasing. Well, for Companies Act and for FEMA, a registered value is sufficient. Why bring in a merchant banker for this? Why not just keep it, or make all of, rather than, if there's an obsession with the merchant banker, rather than amend it for Companies Act and everyone, but obviously that will add to the cost of simple domestic issuance also. So humble suggestion that in this case also it should remove a merchant banker, and because Foreign Exchange Management FEMA has adapted itself and brought in the concept of it and not stuck to the merchant banker. So at least there will be not two valuations from two experts, rather one valuation will be sufficient. And the last point, which it's not a suggestion, but we all know that 60%, 50-60% money comes from Singapore, UAE, Mauritius, Netherlands. And I don't know what's the thought process behind it. At least government should come clearly on this. Now, what does this throw up? So this is not final. There's still open for discussion. They're possible with the way it stands today. There's still structuring options available. When you're looking at captive alternative investment funds or alternative investment funds through GIFT IFSC, that's opening a different window. Issuance of CCDs, because CCPS or a preference share in a hybrid instrument is still covered, but debentures are still, so how you use a CCD, you have to plan around that. Debentures are still out of it. Or investment altogether through, sort of creating data points. But again, they have said that the quantum of investment, if you want to, from a notified entity in a notified location, if you want to use it as a comparable data point, the quantum has to be same. So how do you plan around it, the sequence? So things are probably, someone has to apply his mind on the sequence with whom we can take and the pricing and all of that. All said and done, I feel it's quite absurd. You're actually taxing the capital. People in white capital put a red carpet to get capital into a country, and we are challenging and threatening that if you don't follow this set of rules and you don't follow this set of valuation, we'll tax the capital. Quite absurd, but that's the way it is. Obviously, the intention was good, but I think so with GAR being there, why this kind of a SAR is required. But nevertheless, we have to live with it. Now, I've covered the angel tax also to a large extent, what I could cover, because as I said, this is something which will require a session in itself. But yes, funds coming in from overseas, please be now mindful of there's another milestone you'll have to cross over. Now, having discussed the various issues with respect to issuance of shares, buybacks, which are part of the restructuring exercise, let's now get into other aspects of transfer of business by way of mergers, demergers, and slump sale. One point which often creates confusion in the minds of business houses is the concept of undertaking. Believe me, this word undertaking Basan, you can just flip to the next slide actually. When it comes to the transfer of business, especially in the case of demergers and slump sale, ordinarily of the general notion that we transfer any business, it may either be not be taxable to all due to merger demerger specific provision on tax neutrality, or it could be taxable at a reduced rate when executed through a non-NCLT process or a slump sale scenario. Now, if I were to discuss the meaning of undertaking in colloquial terms, in very simple terms, it would mean a business unit or a division of a company that can be transferred and operated as a separate entity. However, what actually goes into qualifying a business to be undertaking has always been a matter examined closely by the tax department. Failed with litigation. The tax exemption for mergers, demerger, and slump sale is primarily questioned on the basis on what has been transferred and not an undertaking, but only a combination of assets and liabilities. Now, if they challenge it's nothing but assets and liabilities, it could lead to a lengthy and expensive litigation, apart from opening up issues like GST and stamp duty as well. So there are various questions which normally comes to one's mind, like what is actually undertaking in tax language? I explain what is there in a simple mind, in a colloquial language, in a simple word, what does it look like? What are the conditions associated for transactions like merger, demerger, and slump sale for the purpose of qualifying as an undertaking? What we also see that different types of businesses may have different meaning of undertaking. Like what could be an interpretation for a manufacturing business may not be the same for a service industry, which is largely driven by manpower. Further, it is a requirement that what is being transferred is a business activity in itself and not a bundle of assets or investments only. The tax authorities are increasingly scrutinizing merger and demerger, even though they are court-approved schemes. Some of the specific example which comes to my mind, which I would like to deliberate, rather my colleague person would deliberate upon is, when a particular asset or liability is considered to be part of an undertaking, whether a particular asset or liability is considered as a part of an undertaking. What does a merger or demerger transaction qualifies for tax exemption? When does a merger or demerger transaction qualify for tax exemption? There are a number of conditions that must be met in order to qualify for it, to enjoy the tax neutrality which are provided under Section 47. These could be very complex. Is it possible for the parties to have a transfer business without all asset liabilities forming part of the business? There could be various instances where the buyer or the seller may not be interested to buy or give away a particular asset or liability of the business. So it will transfer the business, but probably one odd asset it may want to hold on. Say I want to transfer the whole business, but I may just want to hold on to the land because the business will continue. The business will be operational. It will be a going concern even without that parcel of land. So in such cases, does it create a problem regarding the taxability of transaction? How does one deal with such a situation? With these questions which may come in anybody's mind, let us see how some of the recent cases have been dealt with in the meaning of the term undertaking. Basant, could you just share and discuss at least 2 rulings on the subject?
Sure, Aditya. So moving to the first of the rulings with respect to undertaking, as Aditya mentioned, that in any NCLT driven schemes, or in fact a non-NCLT driven reorganizations, wherever there is a slump sale, there is a concept of undertaking which one needs to be very mindful of. So undertaking, if I were to say, as per the Income Tax Act, what it means essentially is a business or a part of the business which is being transferred by one entity to another, rather than combination of assets or liabilities of that of a business. So if I were to do a combination of assets and sell it to someone else, it may not be a whole business as such. That is where the concept of undertaking says. So the transfer should be, in a sense, a group of assets and liabilities along with all the employees, your contracts and everything, which allows the buyer to run the business which he's acquiring. So we would discuss one of the cases which was a very crucial case which has been lying before the ITAT for quite some time. This was a case where the business which was getting transferred was in fact an investment business of an entity which was being transferred to another entity through a demerger scheme. Actually, this case involved a lot of other transactions also, where there was initially a merger, which was then followed by a demerger. But here we would limit ourselves only with the demerger discussion, because that is the limited part on the undertaking side, which we need to delve upon. So in this case, what happened, there was a company which was having two businesses. One was business A, for sake of simplicity, I've just kept it real estate business. And so another business division, which was most of an investment undertaking, which was getting transferred. And that investment undertaking, so to say, was more of investments in various group entities, which was getting transferred to the other company through a demerger scheme before the High Court. At that point of time, there was a High Court regime and not NCLT. So what essentially the revenue argued is that the assets which are getting transferred is not a business per se, because it's only a bunch of investments which is getting transferred from one hand to the other hand, and there is no business activity which is being carried on. So what essentially the arguments of the SSC was that it is not that investment activity per se cannot be a business activity for the purpose of qualifying as an undertaking. Even if so there are most of the cases, separate businesses of a group are carried on through separate entities, separate SPVs, and it is not possible for all the businesses to be sitting in the same entity, so to say. At the same time, investments entities are also made to comply with various regulations of the government, and it is also more of commercial reasons as to why different businesses are kept in different entities, because the the SSE may look for having an investor in that entity later on, or he may want to infuse funds later on. So there are various sorts of reasons why a business may choose to have different businesses being run through different entities, and that's why there is a host of investments sitting in the balance sheet of a company, which would be categorized as an investment per se in the balance sheet, but it essentially is a business only of that flagship company, so to say. So this was the basic argument which was put forward by the taxpayer to say that this is a business activity which is being carried out and not a sole or a couple of investments which is getting transferred. And coupled with this argument, there was corroborative evidences which the SSE could also put forward before the tax authorities to say that the tax audit report clearly mentioned that this was a business which was being carried out through different entities. Although the segmental reporting of all these businesses was not there because it was a big conglomerate having various businesses, it was not humanly possible to provide for all these segment details in the income tax return form. However, all these businesses which were being run through the investee companies were forming part of the management discussion analysis and the director report of the flagship company. So with all these arguments and the fact that whatever income were being received by from those investments were largely taken as business income in the books of the flagship company. So on the basis of all these arguments, what essentially panned out is that the movement of all these assets, which were as such categorized as investments, would still be considered as a qualifying business for the purpose of the criteria of undertaking for a demerger. So what comes out from this discussion essentially is that if one were to prove that what is getting transferred is not a combination of assets and liabilities, but a proper business activity which is getting transferred, it should qualify as an undertaking for the purpose of demerger related transactions. And this issue of investment undertaking has been litigated over so many years, and given that this decision has come only last year, it gives a sense of breather for all those companies who would have undertaken such kind of transactions in the past, or they are contemplating to have such transactions. Obviously, if I were to see a NBFC related scenario where the business itself is with respect to say giving of loans, taking of loans, making investments, it's far more simpler to demonstrate that what is getting transferred is a proper business segment, so to say, from one NBFC to another NBFC, so to say, rather in cases where it's not a NBFC but a normal standalone company. But if one were to properly arrange the facts and disclose properly in their financials, in their tax returns, and in their discussions with the public shareholders, there is no doubt that these kind of transactions of transfer of a business undertaking which is holding investments will not pass the test of undertaking for the purpose of demerger. So with this judgment, there are various other cases which have also been supported in terms of having the businesses of investments being transferred to another entities for group restructuring purposes through a demerger scheme. So this is one really important decision which has come last year, which would really help the taxpayers in their structuring related exercises. On this undertaking front, this was the demerger scheme. I would move ahead with another decision which had come, and this is more from Calcutta High Court decision, where instead of what happens is that this undertaking related discussion and the definition, which is there in a demerger scenario in the income tax statute book, is also imported in the transaction of a slump sale. And even slump sale, what the Act defines slump sale is that where a transfer of business happens without values being assigned to individual assets and liabilities of a business. So instead of transferring piecemeal assets and liabilities of a business if one were to do a lock, stock and barrel kind of a transfer of the business of a particular entity, and they don't want to enter into a demerger scheme before the NCLT. It could be simply done through a business transfer agreement between the parties. Obviously, there are various considerations in terms of whether to do a demerger or a slump sale, because normally slump sale happens to be for a cash consideration, unless obviously it is being done through issuance of instruments in a slump exchange scenario. However, in demerger, there are issuance of shares. There needs to be a NCLT driven schemes. So the same thing can be achieved through a slump sale transaction where the SSE may choose to transfer its assets and liabilities to another entity without assigning specific values to individual assets and liabilities. So assume a factory assume a business which is having suppose 3 factories. It may consider transferring one factory to another entity along with all its plant, machinery, land, debtors, creditors, all its loans, employees and everything. So that itself also constitutes a slump sale. So interestingly, what happens in commercial transactions is that whenever there are some transaction, and especially in a third party scenario, what may so happen is that either the buyer or the seller in the transaction may not be interested in the entire assets and liabilities. So it may so happen that there could be a loan sitting in that business, specific loan sitting for that business, which the buyer may not insist on acquiring. And the seller may also be fine with, adjusting the consideration with the loan component. Or there may be some kind of an assets or a brand, so to say, which is sitting in the transferor company, which obviously the transferee company would not like to buy because they would run this under their own brand. At the same time, there could be some other assets. For instance, there could be some debtors which the buyer may not like to take in the slump sale transaction, and consider the pricing of the entire business without those assets and liabilities. So the question really arises in such cases is that if an entity actually transfers its business, and suppose there are some assets which are left over in that transaction, and the buyer acquires so much of the business which allows him to run the business without those assets and liabilities which are left over by the seller, will the transaction jeopardize the meaning of slump sale for the purpose of Income Tax Act? And why so? Because I'm sure we are aware that whenever the slump sale happens, the taxability of slump sale is on a different footing, rather piecemeal assets and liabilities, because slump sale is normally taxed at a lower rate without indexation, and piecemeal sale of assets and liabilities actually involve paying tax at a higher rate. At the same time, it also has other issues in terms of applicability of GST and higher stamp duty and all those things. So generally people consider doing a combination of assets and liabilities transfer through a slump sale mode. Now, in this decision, which was there before the Calcutta High Court, there was a transfer of one business division from a company to another, and there was a loan which was there in the seller entity pursuant to that very business, which the parties decided that this would not form part of the transaction. So the buyer acquired the entire business without that loan, which was left over by which was kept with the seller entity itself. So what essentially the ITAT Kolkata held, that it is not a transaction where all assets and liabilities have moved to the buyer, because a component of the assets and liabilities of the business, which is a loan with the bank, has been left over and has not been taken over by the buyer. So that is where post that decision, this has also been approved and upheld by the Calcutta High Court in last year in the Expro India case, which now gives a sense of feeling that wherever there is a transaction involving a slump sale, will it mean that the seller needs to essentially transfer all its assets and liabilities, and he need to ensure that he doesn't leave any small assets. For that matter, suppose some employees, so to say, because employees also are generally forming part of a business. So if I'm having my factory manager who is running a factory, is it essential that I also need to transfer the payroll of that employee to the buyer? Well, this decision seems to be a kind of seems to be diverging from the earlier decisions which we have seen in slum sale scenarios, where assets and liabilities had been left over by the buyer and seller retained some of the assets and liabilities. However, the crux of the matter normally here lies is that if the acquirer, the buyer, is able to run the acquired combination of assets and liabilities pursuant to the slum sale transaction, then in such cases, it should qualify as a slum sale transaction for Section 50B of the Income Tax Act. And it should not be a case of a piecemeal transfer of assets and liabilities. And there has been a host of rulings in that aspect where certain assets have been left over. In fact, loans have been left over, or brands have been left over. Obviously, employees have been left over, or some debtors, creditors have been left over in the seller entity, and these are retained. There are decisions earlier which is there from the Delhi High Court. There are decisions also from Punjab and Haryana High Court. In fact, if we see the Calcutta High Court rulings in the past, there has been earlier rulings from the Calcutta Tribunal and also from the Calcutta High Court, where it has been held that only because some of the assets or liabilities were left over, it would not disqualify a slum sale transaction. However, this recent ruling, which has come last year in the case of Ex-Pro India, is something where we need to be very mindful of and to ensure that how we match our facts, which is not very similar to these facts, and we rely on decisions which are other decisions also which are favorable to the SSE. And one more point to be noted here is that this decision which came last year in the case of Ex-Pro India, it was a kind of a standalone decision where, the past decisions of other high courts, and in fact, the jurisdictional Calcutta High Court was also not referred to. So one would always need to be mindful of these surprises, which at times come from an authority as high as a high court as well. So these were a couple of decisions with respect to an undertaking. One where there is a transfer through a scheme of demerger, and secondly, if it is not a demerger, where the party decide to do it through a non-NCLT driven process, how it happens in a slum sale, and what recent precedences are there which has come up from the judiciary. Aditya, we can further take up some other issues also if on these.
Yes, Basan. So thank you, Basan. I think so. You've given two contradictory rulings. One is Calcutta High Court, and the other one was which place was it?
This was the Mumbai Tribunal in the case of Grasim, which was on an undertaking of an investment undertaking, transfer of an investment undertaking.
Basan, I would want to touch one more topic, which is a very critical topic when there are restructurings within the group, and when there's an acquisition and there's an acquirer and the company and another company is being acquired, this becomes a very critical aspect, which is the carry forward of losses post amalgamation. So can you just quickly run us through? We have some time. We are at 4:15, so we can just shorten the question answer session. There are not many questions also which are there. So could you quickly run us through those 2 or 3 or 1 or whatever case laws you have?
Sure, Aditya. So, as very rightly pointed out, normally, whenever there are losses in an entity and there are acquisitions of those businesses or companies altogether, the acquirer would always like to enjoy those losses to the maximum. Now, before discussing this decision, we'll just touch upon the background of losses in case of demerger and how they stand with respect to other transaction of losses, suppose in case of a merger. So the way the Income Tax Act is codified, whenever there is a loss in a particular undertaking which is getting demerged, the losses which pertain to that particular undertaking is allowed to be taken over, and it travels to the resulting company after the NCLT scheme. So if I were to just continue with my earlier example of maybe 3 factories in a company, and there was one factory which was loss making and which is supposed demerged through a NCLT scheme to some other entity. So the acquirer entity would have the right to take the losses which is there in that particular loss making factory, because that's the factory which is getting demerged. So that's a specific loss sitting against a specific business is where the loss travels. Unlike the demerger, in merger, there are a host of other conditions for enabling loss to be traveled to the amalgamated company, where it should be an industrial undertaking. There should be criteria for utilizing the capacity of that business. All those criteria are not there in a demerger scenario. So that's where the differentiation between eligibility of losses in a merger and eligibility of losses in a demerger varies. Now, coming back to this decision, which was the Pune ITAT decision last year, which came in the case of Cummins Sales and Services, what had happened is that there was a demerger from a subsidiary company to the holding company, and the losses of that business of the subsidiary company was moved to the holding company pursuant to the scheme of NCLT. When the NCLT observed and the assessments were, when the holding company's assessments were done by the assessing officer, it was noticed that the business of the subsidiary was sitting in the housing company, obviously as per the demerger scheme. However, the assets and liabilities were shown in the resulting holding company as being held for sale. So the intention, what looks from the balance sheet and the financials of the holding company gave an impression that the assets which were acquired through the demerger were open for being sold to some other person, or it was there for being sold to any third party. So when this matter traveled to the ITAT in terms of eligibility of the acquirer company to utilize the losses, what the department said that, you know, this is loss shopping which has been done in terms of moving the assets from a loss-making entity to a profit-making entity, and the SEC argued that there is no such provision which would deny the resulting company to take the losses, because what the law essentially says is that the loss should pertain to that undertaking, and since the undertaking has moved, the losses along with it would also travel to the resulting company. Now, when the ITAT examined this issue, they went very deep into the entire intent of bringing this demerger provisions, and they somehow equated these demerger provisions with merger provisions at the time when they were introduced long back in the statute, to say that the intention of giving the benefit of losses in case of merger and demerger was to ensure that the loss-making units are not shut, and these are run by strong, profitable units, and so that there is no burden on the Indian economy and on the government in terms of retrenchment of employees and sick units. Obviously, the conditions are there in the case of merger and not in the case of demerger, but that would not absolve the government in imposing the conditions of merger in demerger cases also. And it would always be important to ensure that the intention of doing a demerger is not bypassed by only doing a shopping of losses. So the ITAT went into the intention of this transaction and said that even though the loss is not, the eligibility of losses is not codified in terms of in the cases of demerger, still the benefit of losses would not be available to the holding company, because they are not carrying on the business on a going concern after acquiring the assets. Rather, they are keeping this for being sold to some other party and only doing the demerger for getting the losses in its profitable business. So we need to be mindful of these kinds of cases, because although in a demerger scheme, there is no specific provision for losses, but these provisions with respect to merger may also come to haunt the SSEs. Very quickly, I have only one another decision, I think if time is there, I'll just do this quickly. See, normally what happens, there is another concept in the Income Tax Act with respect to change of substantial shareholding in a closely held company. If I were to say companies generally which are not listed or a promoter driven companies, if I can say colloquially. So whenever there is a change of shareholding of closely held companies of more than 51%, the existing losses in that company is not allowed to be carried forward after the transaction in that company. So the acquirer, in a sense, loses the benefit of losses in that company, although he may acquire more than 51%. Because what the law says is that the person who would have incurred the loss should essentially continue with the same company as a shareholder for recouping the loss, and once the profit arises in that company. Now, what happened in this case is that there was normally there are a lot of acquisitions which happen where instead of doing a direct merger of the target company, the buyer essentially first would like to test the waters and buy some shares and take a majority stake in the company, and then effectively merge it into itself. So this is what the same thing happened. There was a company which acquired another business of a loss-making company by acquiring 51% shares in year one. And subsequently, the next year, the company merged that company into itself. So since the company which was acquired, the target company was having losses, and it was subsequently merged and folded into the holding company itself, the SEC said that essentially what I have done is that I have just acquired the company, and it was only a step transaction where I did a acquisition which was followed by a merger. However, very interestingly, what was noted by the Mumbai ITAT in this case is that when the acquisition happened in year one, where the shares were acquired more than 51%, at that very first year, the existing losses got lapsed because of the trigger of section 79, which we just spoke about in terms of substantial acquisition of holding of a loss-making company. So in our example here, if we see year one, the moment M company sold the shares of K company to H company, in that very first year, the H company, the loss sitting in K company got lapsed, and K company could not then further carry forward the loss after the transaction in year one itself. So if in year two, there was a merger of K company to H company, it would not revive the losses of K company so as to have the losses being shifted to H company, so to say. And the interesting part of this decision is that there was a gap of only 1 day in this transaction, where the year one transaction happened at the end of the year, and the year two transaction had happened on the 1st of April of the next year. So had the SEC been somewhat more, conversant with the tax laws, and he would have thought and done this process in a proper manner, he would have actually saved the losses in this case. Obviously, there could be some other considerations which everybody would not know and would be the only parties to the transaction would understand. But however, only there was, because of choosing a date of merger which was not in the same year in which the acquisition happened, this caused a lot of loss to the SEC in terms of acquiring the business. So we need to be mindful of these kind of transactions also, and to plan our affairs in a manner to ensure that by doing one transaction, my subsequent transaction does not jeopardize the benefits which I'm getting in my prior transaction. So this is also another important aspect which one needs to keep in mind in terms of losses and the appointed dates of different schemes. I had these 4-5 case studies to discuss.
Thank you, Basant. I think so. I have a few more, but with the paucity of time. But I think so. We covered what we wanted to cover. There are more rulings on the subject which we could cover. Sharbani, Basant, there are 2 or 3 questions. If you could just look into those and answer. I think so. So Yashu Segal, your first question: can we set off short-term capital gains under Section 50 of Income Tax Act with the unabsorbed depreciation of earlier years in case of itemized sale? Yes, I think so. The answer is yes on this. If I look at the second question, but would you look at the second question, please?
Yes, Aditya. So it says that at the time of selling of leasehold land and building, should we calculate capital gains combined, or should we calculate capital gains on leasehold land separately and on building separately? So, the way the Income Tax Act generally functions is that land not being a depreciable asset and building being a depreciable asset is normally considered as a different class of assets, so to say. And there are various decisions on this subject where the taxability of sale
But
of
just one thing, this is leasehold land. So it is the leasehold land as well as a building. So I think so leasehold, could it have a different connotation?
So actually, Aditya, what could happen in such cases is that whenever there is such leasehold land,
it will not go to the block of assets. So it will not go to your block of assets in tax, even if it is used for business purposes. So it will remain out of your block of assets, right? It will remain as a right in your books.
Yes, Aditya, it would remain as a right in my books. And when I am selling the building on that land, the portion which is there for the building, obviously that would have to be ascribed with the 50C stamp duty valuation before it is being subjected to income tax, and the amount which is being so received for the purposes of surrendering the leasehold rights, so to say, it will depend on how the seller has actually treated the leasehold premium which you would have paid at the time of acquiring such land in terms of taxability, because different HSCs take a different stand in terms of treating the premium paid and amortizing, or maybe taking it in the first. It's very factual issue which actually one needs to see.
And I'm not clear, it is leasehold land and leasehold building, or is it just the leasehold land and the building separately?
Right, because at times it also happens whenever there is a leasehold land and we are constructing a building. At times, it could also lead to a scenario where one could become a deemed owner of that property, and the leasehold land may also be considered as
I understand, Basan. I think this thing
more of a factual questions.
Yeah, probably we'll have to connect with the issue to understand this better. On the last question, in case of a demerger, whether the resulting company can claim MAT credit available with the demerged entity. If yes, then how to allocate such MAT credit between the demerged undertaking and the remaining undertaking? So you dealt a lot in this. Please, Basant, you would like to. You and I have done it.
Yeah. So in terms of MAT credit, movement of MAT credit in NCLT driven schemes, although there is no specific provision mentioned, but there are various decisions which has come up. And if I were to recall, the very earlier one would have been, I think, Adani Gas and all, and there are other decisions also, which have generally spoken about movement of MAT credit in scenarios of mergers and demergers. So in case of demerger also, it would be a good case to take the MAT credit in the resulting company. And since the common assets are normally apportioned between the demerged entity and the resulting company on the basis of net worth, so that could be a correct base, so to say, for doing a calculation of a MAT credit which is general in nature and which is not specific to a demerged undertaking. Because if it suppose pertains to a if it pertains to a tax holiday business which is being transferred through a demerger, and there is obviously no MAT credit in a non-tax holiday business, and the demerger happens for a tax holiday unit, one can always take an argument that the entire MAT credit belongs to the demerged undertaking only, and it should then travel to the resulting company.
Sarvani, it's 4:31. So
Yeah, we have one more question from Nandini Agarwal.
I couldn't see that. Just one second. Okay, yes, there is. Will an investment JV, just the investment, constitute an undertaking for a demerger? My initial answer would be, although one should look into the facts, but the immediate answer is a no. You cannot have just the investment, although you have some ruling, but then it's the Aditya Birla ruling is there, but I don't think so. Just an investment in a JV would constitute an undertaking. There's a lot more to an undertaking. But obviously, we need to understand the facts. But my initial answer would be, yeah. So Sharvani, I think so. It's 4:32.
Yeah, so we can close now.
Yes, sir. You want
Okay.
Vikas anyone to put a closing remark, or we'll just close it at this?
No, we are closing right now. So you can
Thank you.
close the close.
Thank you, Sharwani. Thank you, Bengal Chamber of Commerce. Thank you for organizing this. Thank you, everybody. Thank you, audience.
Thank you,
you
everyone.
also, Mr. Aditya Hans and Mr. Vasant Gandhi. It's very nice to jointly organize a session and also very enriching. Thank you all.